Imagine stepping into the boardroom of a massive telecommunications provider.
Hmm.
I mean, a massive entity serving over 33 million clients.
Yeah, and imagine being told that your mandate isn't just to keep the lights on,
Right.
but to completely rebuild this legacy utility into a nimble, digital-first tech co.
And your working environment is just, well, it's a Category 5 economic hurricane with inflation hitting 211.4%.
Exactly. It's a completely brutal environment.
That is the reality of the case study we're unpacking for you today. We're looking at the latest annual and ESG reports of a telecom giant, which we'll just refer to as the company.
Right, maintaining a bit of anonymity so we can focus strictly on the mechanics of the strategy.
Exactly. Our focus for this deep dive is dissecting how this behemoth managed to not just survive a historic economic storm in 2023, but actually fundamentally rewire its operational DNA.
It's a brilliant case study because the scale we are dealing with here is staggering. They aren't just selling data plans anymore. We are talking about a highly integrated ecosystem. They manage mobile and fixed connectivity, a massive entertainment platform, a digital fintech wallet, and an extensive suite of B2B tech solutions encompassing, multi-cloud architecture, IoT, and cybersecurity.
They're basically woven into the fabric of almost every part of the digital economy in their region.
They are, and 2023 put that entire ecosystem under unprecedented stress.
Unprecedented almost feels like an understatement here. You've been looking at the macro environment data from the report, and it paints a pretty grim picture.
Oh, it really does. We're looking at a highly volatile electoral year, a global economic deceleration, aggressive monetary tightening, and of course that staggering 211.4% local inflation rate.
Operating in a market with inflation running north of 200% completely shatters traditional corporate finance playbooks. You can't just rely on historical modeling for that.
No, you absolutely can't. But when you look at their financial panorama, it tells this really fascinating story of operational resilience. Let's look at the top line. Revenues were over $2,059,101 million.
Which is an astronomical number on paper.
It is, but adjusting for that hyperinflation, that actually represented a 9.3% year-over-year drop in real terms.
Right, which is just the mathematical reality of their position. When inflation is moving that fast, a company providing essential connectivity simply cannot pass the full weight of those rising costs onto the consumer.
Exactly. If they try to match pricing to a 211% inflation curve, they basically collapse their own customer base.
They have to act as a shock absorber.
Precisely. They absorbed a massive hit to protect market share. But here is the critical data point that makes this strategy so compelling. Despite that intense top-line pressure, their EBITDA stood strong at $579,396 million.
Wow.
And even more impressively, their EBITDA margin actually expanded. It moved to 28.1% from 27.5% the previous year.
Improving operational margins to 28.1% while top-line revenue drops by 9% is a brutal needle to thread. It tells us they weren't just trimming fat. They were fundamentally restructuring their operating expenses in real time.
They were forced to be incredibly disciplined.
But I want to push back on something in the financials. They reported a net loss of $249,687 million. Yes, the report notes that's a massive 61% improvement over the previous year's loss, but it's still a loss.
Correct.
Yet they distributed $104,445 million in dividends to shareholders. Simultaneously, they're taking on debt. I mean, they issued $396 million and $37,435 million in negotiable obligations, plus they secured a $120 million line of credit from multilateral organizations. Are they essentially funding dividends through debt while operating in the red?
It's the obvious question to ask, but you really have to look at the structure of that capital. The $120 million from multilateral organizations is strictly ring-fenced to fund physical infrastructure, specifically their 5G rollout.
Okay, so that's locked for CapEx.
Exactly. The negotiable obligations provided crucial liquidity to navigate the local currency volatility. As for the dividend in an environment this chaotic, distributing capital is about signaling absolute stability to the markets.
It proves to institutional investors that despite the paper losses driven by currency translation, their underlying cash generation remains incredibly robust.
Spot on. And let's talk about that currency translation, because the 211.4% inflation is only half the story.
Right. The currency devaluation was actually significantly worse.
It was devastating. While local inflation was 211.4%, the local currency devaluation against international standards was a staggering 356.3%.
Which is just It's hard to even wrap your head around.
For a tech co that relies heavily on importing hardware, servers, and network equipment priced in global reserve currencies, that creates a catastrophic mismatch. That single dynamic generated a net financial loss of over 460,991 million on paper, purely from exchange rate differences.
I can't even fathom trying to balance a corporate ledger when your local currency loses that much value in a single 12-month window. The report mentions they had to rely on extreme creativity to manage this.
Extreme creativity is a nice way of putting it.
But what does extreme creativity actually look like on a Tuesday afternoon for their finance team?
It means moving completely away from quarterly or even monthly planning. They shifted to daily, sometimes hourly, revenue to cost equity tracking. They had to dynamically renegotiate hardware contracts while adjusting algorithmic pricing models for their prepaid customer base in real time.
So they're constantly tweaking the dials just to stay afloat.
Exactly. It requires zero-based budgeting on a weekly cycle, heavily relying on decentralized management teams to make instant calls on capital deployment without degrading the client experience.
Because if latency drops or the network stutters, clients churn.
Yes, and if churn spikes, that delicate revenue equity collapses entirely.
And while they are fighting this two-front war against inflation and devaluation, they were also fighting the government. Let's look at the regulatory landscape.
The company was operating under a highly restrictive government mandate, Decree 69020. This wasn't just a minor regulatory hurdle. The decree classified telecommunications as a public service.
Which changes everything.
In this specific legal jurisdiction, that classification meant the state dictated price ceilings. The company had to seek explicit regulatory approval for any price increase.
Which fundamentally breaks the unit economics of the business. You have a government regulatory body dragging its feet on authorizing price bumps while your underlying operational costs are floating freely on a 200% inflation curve.
It completely crippled their ability to dynamically manage working capital. So they took aggressive legal action. They fought the decree in federal court, and in November 2023, they won.
Huge.
The court declared the decree and its related resolutions null and void. Restoring their ability to independently set pricing strategy was arguably their most critical strategic victory of the year.
So they navigated the currency collapse and they defeated the regulatory price caps. But the third challenge they highlight is an internal one. It's the technical debt, maintaining legacy infrastructure in a tight economy.
You cannot operate as a nimble tech co if you are spending massive amounts of capital putting band-aids on 20-year-old physical networks and legacy copper wiring. It drains your CapEx, it's highly energy inefficient, and it creates massive bottlenecks.
Which explains their aggressive push toward what the report calls cloudification. But to be clear for you listening, this isn't just about moving files to a remote server. We are talking about deploying modular edge data centers.
Right.
By moving the processing power closer to the user at the edge of the network, they dramatically reduce data transport costs and lower latency. It's a structural change to their network architecture that fundamentally lowers their maintenance costs.
That structural shift is exactly how they expanded that EBITDA margin we discussed earlier. And it perfectly sets the stage for the massive strategic moves they made in 2023.
Let's transition right into those moves. Because the infrastructure they are building isn't just for smartphones. It's the foundation for the next decade of enterprise tech. In October 2023, the company won Lot 2 in a major government spectrum auction, securing 100 megahertz in the 3.5 gigahertz band.
Which is a huge deal.
But the price tag was steep. A $350 million investment.
It's a massive capital allocation. But the 3.5 gigahertz band is often referred to as the Goldilocks band for 5G. It provides the perfect mathematical balance between broad geographic coverage and ultra-high data capacity.
I have to play devil's advocate here, though. Throwing $350 million at long-term illiquid infrastructure in the exact same year your local currency devalues by 356% sounds borderline reckless. How does a management team justify locking up that kind of capital when they are already operating in a highly volatile, capital-constrained environment?
Because the opportunity cost of not investing is fatal. 5G is not about faster download speeds for consumers. It is the absolute prerequisite for the digital development of the country's industrial base.
Right.
We are talking about autonomous manufacturing facilities, smart logistics grids, and real-time IoT deployments. The enterprise market relies on that specific 3.5 gigahertz spectrum to function. If the company delays that investment to protect short-term cash flow, they hand the enterprise market to a competitor for the next decade.
That makes total sense.
And frankly, the market is already there. The company currently has over 1 million clients equipped with 5G-ready devices.
They are building the toll roads before the traffic arrives. And this ecosystem play doesn't stop with infrastructure. When you look at how they are capturing the consumer market, it naturally bleeds into their financial services. Their digital wallet experienced explosive growth, crossing the 2 million client threshold.
The growth of that fintech arm is fascinating because it was driven by a deep understanding of consumer psychology during hyperinflation. They launched an investment feature within the wallet, essentially a mutual fund allowing users idle money to generate daily yields.
Which is brilliant product market fit. When inflation is destroying purchasing power daily, consumers are desperate for yield just to tread water. In just 7 months, that feature skyrocketed to become the second largest mutual fund of its kind in the entire industry.
To solidify that vertical integration, the company acquired a 50% stake in their fintech partner, OpenPass. That move signals a definitive departure from being a traditional telco. They are actively building a walled garden.
A unified digital ecosystem where you pay for your broadband, consume your entertainment, and grow your savings on a single platform.
Exactly. And that consumer walled garden is mirrored by what they are building for the B2B segment. SMEs now make up 97.6% of their corporate client base. But they aren't just selling them dedicated fiber lines anymore. In 2023, they acquired a regional cybersecurity firm called Ubiquo.
This is where their transition to a tech co truly materializes. Every small and medium business is hyper-aware of ransomware and endpoint vulnerabilities right now, but they lack the capital to build in-house security operations centers.
The company is stepping in to offer enterprise-grade cybersecurity as a managed service. By partnering with global heavyweights like Google, AWS, and IBM, they are positioning themselves as the unavoidable digital infrastructure partner.
Whether a logistics firm needs multi-cloud architecture, IoT sensors for a warehouse, or endpoint security, the company provides the entire stack.
It's a comprehensive digital land grab.
Now, managing physical infrastructure, data centers, and the financial data of millions of people brings us to a critical part of their operational strategy.
ESG. Environmental, social, and governance metrics are no longer just PR exercises. They are heavily scrutinized risk management frameworks. Looking at the E, the environmental pillar, the energy demands of running-edge data centers and a nascent 5G network are astronomical.
That massive power consumption leads directly into how they're handling their environmental footprint, which is arguably their biggest operational vulnerability. They recognize this risk explicitly. In 2023, they initiated a TCFD risk analysis.
That's the Task Force on Climate-Related Financial Disclosures. And for you listening, a TCFD analysis is not a corporate sustainability survey. It is a rigorous financial risk model. Yes, it requires a company to mathematically weight the vulnerability of their physical assets, like those new modular edge data centers, against highly specific, localized climate change scenarios.
It translates environmental risk directly into financial exposure.
Exactly. To mitigate that exposure, they have aggressively targeted their energy mix. They've set a firm target to source 50% of their operational energy from renewables by 2030, and they aim to hit 22% by the end of 2024.
That's ambitious.
In the interim, they've focused heavily on the circular economy. They hosted their first fully carbon-neutral corporate events, rolled out SIM cards made from 100% recycled plastic, and operationally, they managed to recover 75% of equipment returned by customers.
Like broadband routers and TV boxes, which is a massive win for their OpEx as well. Refurbishing a recovered router is exponentially cheaper than sourcing a net new unit constrained by supply chain delays. Moving to the S, the social pillar, what stood out in the data?
The sheer scale of their social investment footprint is notable. Currently, 83.3% of the company's operations are covered by social initiatives.
That's a huge coverage area.
It is. They are heavily prioritizing free digital inclusion programs, specifically designed to train youth in the technical skills required to feed into their own tech code talent pipeline. Internally, managing employee morale during a chaotic, high-stress corporate transformation is incredibly difficult, yet they achieved a Great Place to Work certification with an 82% climate satisfaction rate.
Keeping your workforce aligned and motivated while aggressively shutting down legacy apps and pivoting to agile methodologies is a massive leadership win. Finally, the G governance. When you are operating a fintech wallet for 2 million people and managing enterprise cybersecurity, your governance structure is essentially your license to operate.
Their governance metrics in 2023 reflect that reality entirely. They certified over 1,600 employees in their integrity program and conducted strict, formalized due diligence on over 1,500 active suppliers to enforce their code of ethics across the supply chain.
And on the technical side,
On the pure data security front, they successfully recertified under PCI DSS, ensuring bank-grade safety for credit card processing across their platforms.
but the report also points to an evolving governance risk on the horizon regarding international regulation, right?
Yes, absolutely. Because they are globally exposed and access international capital markets, they are rapidly adapting their governance structures to comply with the newly implemented highly stringent SEC rules in the United States regarding cybersecurity.
Under these new frameworks, a cyber breach is no longer just an IT issue.
No, it is a material financial event that must be instantly quantified and reported to shareholders. They are actively refining how they define and measure the materiality of potential incidents to ensure absolute compliance.
Which brings us perfectly to where this massive ship is sailing next. The report outlines three primary objectives for the upcoming year, and priority one is capitalizing on that massive CapEx layout we discussed: urban 5G deployment.
They deployed $350 million to secure that spectrum, and now the priority is relentless monetization. They are targeting high-density urban centers to trigger the industrial digital revolution we touched on earlier. The focus is getting enterprise clients fully integrated into 5G-enabled automation and IoT networks.
Priority number two is where they break out of their geographic constraints: regionalization and generative AI.
The strategic goal is to evolve away from siloed, country-specific technology stacks and build unified regional platforms. That architecture provides massive scalability. If they engineer a brilliant software solution in one market, a unified platform allows them to deploy it across the entire region instantly.
And Gen AI is the accelerant for this.
Yes, they are actively exploring generative AI not just to optimize internal coding and operational workflows, but to dynamically generate hyper-personalized client experiences at scale.
Which is incredibly ambitious. But priority number three brings us right back to the stark reality of their macroeconomic environment: financial survival through efficiency. The report explicitly warns that the upcoming year will be plagued with even greater challenges.
It's a very sobering, transparent assessment from management. They know the macroeconomic volatility isn't stabilizing anytime soon. Therefore, the critical operational directive is deepening those cost optimizations, relentlessly enforcing financial equity between revenues and expenses, and fiercely protecting the massive capital investments they've made in 5G and AI against future currency shocks.
It is an absolute masterclass in corporate tightrope walking. We have covered a massive amount of ground today, analyzing how a legacy utility fundamentally rewired itself under extreme duress. Let's distill this down into the core insights you should take away from this deep dive. First, the traditional telecom model is dead. This company's aggressive and highly successful expansion into fintech, capturing millions of digital wallets, alongside their acquisition of enterprise cybersecurity firms, proves that survival requires morphing into a resilient, vertically integrated digital ecosystem.
Second, absolute financial agility is paramount in emerging markets. We analyzed a company facing 211.4% inflation and a massive 356.3% currency devaluation, and yet through dynamic algorithmic pricing and ruthless cost restructuring, they managed to expand their EBITDA margins and secure critical global financing. That level of operational efficiency really redefines crisis management.
And finally, true future-proofing requires immediate and often painful sacrifice. Deploying $350 million for 5G spectrum and aggressively pushing toward renewable energy targets in the middle of a severe economic crisis highlights a management team that is willing to endure short-term financial pressure to guarantee long-term market dominance.
It's a fascinating study of corporate courage. They didn't retreat, they accelerated their transformation when the market was at its most volatile.
They absolutely did. And it leaves us with some highly compelling strategic questions to ponder. For you listening, consider this. How does a massive traditional utility successfully pivot its brand and operations to become a nimble techco without completely alienating the legacy customer base that still relies on those basic, everyday services?
And from an investment perspective, can heavy, sustained capital investments in transformative technologies like 5G and generative AI truly outpace the structural, margin-crushing drag of hyperinflation in emerging markets?
Ultimately, the most profound question this raises is about valuation. If an infrastructure company in a volatile market can successfully monetize these digital ecosystems, will capital markets eventually stop valuing them as slow-growth utilities and start pricing them like high-growth software companies?
The techco transition entirely changes the fundamental DNA of the asset.
That is the multi-billion-dollar question. Thank you for expertly breaking down the data and the strategy with me today, and thank you all for joining us on this deep dive. We'll catch you on the next one.